Hey guys, Eric here, Mr. Fired Up Wealth. I apologize for being absent for a little while. I'm actually working on a house project, and you know how those things go. There's always surprises, and everything takes longer than you want it to. So I do apologize. Today I wanted to shoot a quick video that I thought would be interesting, especially to some of the followers, some of the subscribers. Most of my assets are in a taxable brokerage account, and the reason for that is I am trying to, fire it up well. So financial independence, retire early off dividends. So my goal is to actually be able to retire from a corporate role in my 40s and focus on something I want to do, whether that be a different career that pays less money, volunteer work, doing more dad, father stuff, whatever that is. And everybody's got their own goals and dreams. But in order to do that for me, I'm using a taxable brokerage account. And the reason for that is I don't have to wait till retirement age in my 60s to draw funds. My plan is to actually use outperformance, sell outperformance, take that outperformance, and buy dividend growth investing stocks. So in order to do that, I'm leveraging a taxable brokerage account. I have a pretty large brokerage account that I've been grinding on for 20 years. Started out really small at $50 a month, and it's grown and grown and grown. And I've had some of these holdings for a very long time and have done very, very well, especially letting those dividends drip and reinvest. So let's just jump right into it. So as of today, today's Halloween, so happy Halloween, October 31st, 2019. This is a screenshot from just about an hour ago. So this is the morning of Thursday, October 31st, 2019. Here's my top 20 holdings, and I have about 100 holdings total. So this is top 20. There's probably 95 total holdings. So there's 75 other holdings that you don't see. Most of those holdings are more growth and not as much DGI in those. Very aggressive, some cannabis, some, you name it, I've probably got it. These are my long-term holdings that I plan on holding for at least 5 years. And you'll see I've got 24 shares of Amazon that I bought under $1,000. I think my cost basis is maybe $700. So I'm up, 24,000 just on Amazon if I sold right now, but I'm holding it. I'm hoping for 2,300 in the next 18 months, and I'll reassess whether I'm going to shave some then or not. I think it's undervalued right now, in my opinion. The one-day shipping, the last earnings, they got hit hard, and they went down, 5-10% after hours, and they rebounded, really quickly. So it is resilient. I think most people realize the potential in this price range. Some people will tell you you're crazy and that it's way too expensive at this range, but I've been a believer in this stock for a long time, mostly because of AWS, and I also like the one-day shipping. I think that's going to open up opportunity. They also announced a couple of days ago they're going to do free 2-hour grocery delivery, which I think would be, it's got to be burning some cash for them, but Bezos and his management team know what they're doing. I trust them. They are my largest holding, okay? When you go down the line, next is more tech, QQQ. That's the, if you're not familiar, it's like the NASDAQ 100 ETF. That does pay a dividend. So you'll see I have 100, on the right-hand side, it says quantity. I have 189.459 shares. The reason I've got fractional shares on a lot of those is because the dividends are reinvesting, and you get, partial shares on that dividend reinvestment. But QQQ, I think, pays around 0.75% dividend. It is my second largest holding, so it has a lot of the FANG stocks and the tech stocks in there. But I do see it doing well long term. Obviously, when you have a market downturn, it's one of the first things that gets hammered. But it's something that I plan on holding. I'm still young. I'm in my early 40s. I'm actually 41. So anyway, Microsoft. I've had Microsoft. That's my third largest holding. I have 213 shares. I've had that for years. I'm up, I think, over 300% on that, and I've reinvested dividends for many years. It's been a really good performer for me. It was one of those stocks that just sat there for a long time and didn't do anything, and then just kind of took off. And I think there's, like, Google and Facebook are kind of in that position now where they're kind of just been churning. Google hasn't done anything for a couple of years, but I think that one's going to take off at some point. So a lot of you might be surprised to see Oracle as my fourth largest holding. For those of you that follow the channel, you know that I got my career started in software at Oracle, worked there for a couple of years as a sales executive, got a lot of experience, and helped me get the role I'm in now. Most of those shares were bought, at $12 or $20, when I worked there back in 2008. So I'm up big on them. The reason I haven't sold all of them is I'm in a higher tax bracket. So on my long-term capital gains, I'm paying 20%, not 15%. So the idea is that it pays a solid dividend of like 1.8%. It's a solid company. I sell training for Oracle, so I'm well in tune of the business model and what's going on. And I feel like the company is positioned well to at least market perform for the next 5 years. And my plan is when my income level goes down, when I do my corporate retirement, that I will probably liquidate most of those shares and convert those into ETFs. But I've sold a lot. I still have a lot, and it's my fourth largest holding. That was an employee stock ownership program that I rolled into my brokerage account after I left the company. The fifth largest holding is ITOD. If you're not familiar, that's the iShares Total Market Index Fund. It has the S&P 500 as well as 1,500 other largest. So it's the top 2,000, either 2,000 or 2,500 companies. And so it has, some of the mid-cap stuff in there as well. Have about 400 shares of that, and that does pay a dividend. So there's more DGI there, and I continue to add to that. My goal at retirement is to have 50% ETFs and 50% DGI, and I'm continuing to grow those as well as 4 other ETFs, QQQ being one, so those 2. And there's 3 others that if you check out the channel, there's a video called my top 5 ETF holdings. And those are the ETFs that I'm continuing to add to. So when I sell profits from, the growth companies that I buy, like the Fastleys, I'll make 100% return on that in, a couple weeks. And I'll sell that and take the profits and I'll put it into something like an ITOD or a QQQ or one of the other, like DGRO. And there's a couple others that I invest in that I'm trying to build larger positions in. Next, you got AbbVie, which I've had for a while. It's been up and down, but I'm up pretty big on that, and it pays a really solid dividend. I like the recent acquisition, and I do think that one's positioned well to outperform over the next several years. Cisco is one, number 6, that I've had not as long as the rest of these. In fact, I loaded up most of my position when they got hit really bad in their last earnings, and I think that it's a $55 stock. They had weak guidance, but with 5G, with cloud, with autonomous driving, you think of all the different things that Cisco can, leverage over the next 5 to 10 years with growth. I think it's a great DGI company paying, 2.8% dividend. And I think there's solid potential for several different areas that they can grow their business. So I like that one, and I continue to add to Cisco. That's one of my favorite picks right now for DGI. Apple, had that for forever. I've killed it with that stock. I've done so well, and I've actually sold a lot of it, but I still have almost 90 shares. Now it's up to $247. We're close to a 52-week high as of this morning. Google, I've had that one since about $800, and it hasn't done well over the last couple of years. Their last earnings wasn't that spectacular either, but I do think that it's pretty inexpensive for what you get. And with Waymo and all the different things they're doing, I do like that company long term. I've got 17 shares of Google, and I will continue to hold that as long as the story doesn't change. Facebook, 106 shares of Facebook. We're back to the $200 range, 197. Had a pretty strong earnings. Obviously, there's some risk with antitrust and with the election and all those different things, but I do like the business model. There's not a lot of competition that can do digital advertising in the way that they can, and I've actually used Facebook advertising for Fired Up Wealth, and it's pretty inexpensive. You get a lot of bang for your buck, and I see that one. I see it doing well for at least the near future. I'm not sure about 10 years, but I'm holding that one for now, and at some point I'll probably unload that and convert it into DGI. AT&T is next. I've got 525 shares. I've had that one for a while. I was buying it in the 20s. I actually had Time Warner and AT&T. So when the merger happened, I got more shares of AT&T for my Time Warner shares. And I've done really well. I was adding to that when it was down to like $27. The 52-week low is $26.80. I loaded up at $27.50 or something. Now we're trading $38, and they've got a lot of potential with 5G. Got a strong infrastructure. Lots of good things going on with that Time Warner acquisition, HBO. Obviously, DirecTV has some headwinds. There's some risk with cord cutting there, but I do like their streaming strategy, and I do think that they will execute on that long term. And regardless, it's paying, almost a 6% dividend. The dividend is safe from all of my calculations. So even if that thing doesn't, it's outperformed the last year, but even if it sits at $38, I can collect that dividend and feel really good about it. It helps boost my overall yield in my portfolio. NVIDIA, I started loading up more of that around 135 a share, but I had a bunch of it that I bought probably, in the high 190s or something. Overall, I'm still up pretty big on that, and it does pay a dividend. It's like a 0.75% dividend yield, but I got about 90 shares of that, and I think they're positioned well with autonomous driving and 5G, and as well as data centers. So I'm holding that one, for the next 3 to 5 years. Bank of America, I bought that before Trump was elected and got it really cheap. You can see the 52-week low on this was $22.66, and now we're back up to a 52-week high range around $31.50 or so. The 52-week high is $32.23. But that thing pays like a 2.8% yield. It's just a good DGI stock, and it's one that you can feel good about holding long term. I don't see Bank of America going anywhere. It's one of Warren Buffett's largest holdings. And I've got several banks, but Bank of America is my largest, mostly from profit. I've probably doubled on that one, since I bought 546 shares, and a lot of those are dividends that are reinvested. But I don't remember the cost basis, but I wanted to say it's like around $20 a share. So I've done pretty well on that one. 70% return. Lam Research is the next one, LRCX. If you're not familiar with Lam Research, they make equipment that produces microchips. So what I like about that is you don't have to put all your chips on, say a NVIDIA or a Skyworks or an Intel or what have you. Most of the large chip manufacturers buy equipment from Lam Research, and they use that equipment to make chips. So it's kind of a nice hedge if you think microchips are going to do well, which I think they will with, again, 5G, with cloud infrastructure, autonomous driving. Everything you buy has more than one chip in it. When you think of autonomous driving, there's hundreds of different chips that have to control those cameras. You've got like Ring doorbells and Ring cameras that all have microchips, your phones, everything. Even the microphone I'm talking into now has a chip built into it. It's crazy. Everything has chips. And I don't see that trend going anywhere. I see it growing and amplifying and accelerating. So I like that one. It pays a really solid dividend, over 2.5% yield. And I've had that one for a long time. I think my cost basis on that one's $125. It's selling at $270. So everything you see in this top 20, I'm way in the green, have done really well on these. And I've had most of them for, several years, and I've continued to reinvest the dividends. Home Depot, next at 67 shares. I've actually trimmed that one a few times, but it just keeps going up. So more power to them. Salesforce or CRM, that's one that's a newer. I haven't had that one for years and years, but I started buying that one around 2018, and I'm at $125 cost basis. It's selling at $157. I see that being a $200 stock in the next 18 months. They've got great leadership. They're positioned well. Their recent acquisition of Tableau, if you understand the business and how analytics work and corporate visibility works, there's tremendous opportunity in that space for Salesforce, and they're positioned well long term. And I like that one. I'm gonna hold that one for at least 3 to 5 years. Next is Costco. And I've trimmed that one several times too, and it just keeps going up. When it hit $300, I sold it like 304. I sold probably 50 shares, and I still have 48. It used to be one of my largest holdings, but not that I don't like the company long term. It's just the PE ratio is over 30, and it was a frothy valuation. I sold it, repositioned it elsewhere, and I can always buy more if we have a downturn. But I do like Costco. I have some in my Roth IRA as well. It's one that, I've had for many years. In fact, the first time I went to a warehouse, I said, man, I love this business model. I love this company. This is awesome. Is this publicly traded? Sure enough, it was. I researched some more, and man, this is great. I think we've had that stock now for over 5 years. I want to say we're close to 10 years. So we've done very well in that stock. They've had some special dividends as well as a decent dividend. It's a lower dividend yield. If you're familiar with Costco, it's not over 2% or anything. But next is Boeing BA, and I've had that one for a while. Have 41 shares of that. It's, obviously we've got a lot of issues with Boeing right now. I'm hoping that they figure it out and keep everybody safe. The reality with Boeing is there's really only two major aircraft manufacturers, Boeing and Airbus. Airbus is a foreign, so it's not qualified dividend. Plus, I don't like them as much as Boeing. Boeing is positioned well long term. They just got to figure out their mess with the 737 MAX. But once they do, this stock was a $446 stock on the 52-week high. It's gone down to $292. I loaded up around Christmas last year at $300 a share, and it's trading about $345. As soon as they figure out their issues, though, this is a $500 stock. I don't know when that is, if it's 2 years from now or what, but it pays a solid dividend, and it's a company that's going to be around for a long time. Even with all the issues they have, they still have back orders for years and years, and I'm confident they'll get it sorted out. It's just a matter of time. So Disney, I have a love-hate relationship with Disney because I've got young kids, so I've owned that stock forever. And it did really bad for a long time, if you're familiar. But with their Disney Plus streaming, I prepaid for 3 years of that for $150 or whatever, and a lot of people have. I think with that, and they start advertising on there with Trade Desk and things like that, I think that stock is a very solid DGI. It's a great company. It's not going anywhere. They own Star Wars. They own Marvel. They own, everything. It seems like anytime a movie comes out, it's like, oh, Disney, But that was $147 on the 52-week high, and as low as $100 around Christmas. I actually bought a bunch for my daughters for a Christmas present around that $100 range. And so they're up like 30% in less than a year, which has been awesome, plus the dividend. And then my 20th largest holding is Splunk. SPLK, that's one of my newer positions. When they got hammered and they were below $100, their 52-week low is $83.69. I loaded up on that. You can see the 52-week high is $143.70, and it's trading about $120. But I have 102 shares of that, and I think it's positioned well for the next 3 to 5 years with the cloud space. I know the company well just because I work in the industry, in the cloud industry. And, they have great partnerships and products and a really good following. So I like that company long term. So there you have it, guys. I hope this video was interesting, entertaining. I'd love to have some dialogue, maybe some Q&A. Ask me some questions below, comment and ask me, why do you own that stock? I think this stock is terrible. Why do you have it? I want your feedback. Most of these, like I said, I've had for a long time and I've done very well. So I'm in the green on all of these. If you look at the rest of the holdings in this portfolio, there's some really aggressive stocks in there, like cannabis stocks. And if you can think of something high risk, like I either have owned it or own it now, and I try to use those riskier stocks to outperform the S&P, sell that outperformance, take the profits and reinvest it into ETFs that pay dividends and dividend growth investing stocks. But anyway, guys, thanks for watching this video. Appreciate it. Please do like, please comment, please subscribe if you haven't. Click the little red button on the bottom right, as well as that little bell so you get notifications. Appreciate your time. Have a great rest of your day.